We're your Hawaiian shirts, Robert.
Oh, it's winter time. They tend to be a summer event, you know.
Yeah, I'm
Looks like
with
you
you on
got
that.
looks like you got an undershirt on there to keep you warm.
I do. It's lots of cold, wet weather out here now.
All right, let's
Almost.
get this started. We're running a little behind. Thanks for waiting for us, everyone. I'm subbing in today as the moderator. My name's Steve Lamar. Welcome to Wall Street Beats. Today is what is today? Friday, the 7th of February, 2025. We've got Robert Marson and Charlie Beebody joining us today. I'm subbing in for half our crew is sick with the flu. Today I'm subbing in for Jeff Mackey, so we wish him well. Charlie Beebody is playing hurt today, so thanks Charlie for joining us. And
Sure.
I think Robert Marson's probably got something to say about Skechers. So let's get this started with Charlie. What do you got?
So I was there's a good article in Bloomberg today about the potential losses that the banks face from jumbo mortgages from the LA fires. And I just wanted to mention it because it does imply that there are going to be, hundreds of millions of dollars of losses on residential mortgages, just residential mortgages. Um, and I was talking with a major bank yesterday that has a significant LA presence, and these jumbo mortgages are for high valued properties, and the banks can't sell these off or securitize them; they hold them on balance sheet. And I thought the article was worth reading for the simple reason that when banks reported earnings back in mid-January, JP Morgan Chase sort of set the tone on the LA fires by saying, we don't expect it to be a material event. And, given the status of JP Morgan, they sort of, cut off any sort of questions related to the LA fires and the risks associated with the LA fires. And, I had written a piece, which I posted, I think, Jen, you said January 14th on Wall Street Beats, suggesting that, the banks faced, losses anywhere from, I think it was 250 million to $1 billion from these LA fires. So I was kind of shocked when JP Morgan sort of, put down any sort of talk about risk from the LA fires. And in talking with a major bank yesterday that does have exposure, they acknowledge that they probably do face several, quote unquote, several $100 million of losses from these LA fires related to residential mortgages alone. So I think there is going to be an impact from these LA fires. The timing is a little bit up in the air. Typically what you would expect is some forbearance from the banks, to the individual consumer, maybe 90 days worth of forbearance to see if they can, get back on their feet and deal with all the things that they have to deal with after a devastating fire like this. But then, 6 months later, you probably realize that that forbearance is not going to help, and you have to charge off these loans. Um, so the question is, when do you start to reserve for that potential charge off? If the charge offs are coming in the second or third quarter, you may, set up a reserve here in the first quarter. And so that could be, a negative surprise relative to current expectations if these banks have to set up, a 200 or 500 or $750 million reserve here in the first quarter. So I thought, that article is worth reading, particularly given the conversation I had with a bank yesterday that acknowledged that they probably face several $100 million. So there's a hit coming in my mind. You can go back and read the piece I wrote on January 14th that I posted on Wall Street Beats, because I think it gets close to sizing up the potential hit. Now, the reason that JP Morgan said we think it'll be immaterial event is because they've got a 24 or $26 billion loan loss reserve. And so if they have to set up, $1 billion reserve for the LA fires, it's not in their minds material. But it will affect earnings estimates. So I think it's important to bring that forth given the article in Bloomberg today. So just wanted to highlight that,
So
Steve,
besides
as
besides J.P. Morgan, I would imagine Wells Fargo has exposure, given its
Bank
high
Amer-
end.
yeah, Bank
Maybe
America through
that
Merrill
Bank
Lynch.
America. Okay.
Yeah,
Any
and
of the
then
smaller players where it could be
the
they could be
City National Bank is
it could
big in
affect them
LA.
more.
Yeah, City National Bank is big in LA because and they were bought out by RBC. the Canadian bank. So you got Bank of America, Wells Fargo, J.P. Morgan, City National as a smaller player. But it's whoever is really specializing in these jumbo mortgages. Um, I think you have a little exposure with U.S. Bank Corp as well, um, and maybe PNC, but I wouldn't expect those to be material.
Do you see their credit card businesses being affected?
Well, that's what I wrote about, because those are unsecured loans. And, if you think about the Palisades and the type of people that live there, it was high-end people. They hired gardeners, they hired, service people, they hired dog walkers. And all of these people are without jobs. And that's the type of consumer that does live off of their credit card. And if they can't get a new job in the area, I think you are going to see some defaults on credit cards. And then,
Yeah.
I had a friend that lost his house and his truck in the fire, but his truck had all of his tools. He was an independent contractor. And while he had collision on the truck, he had no insurance for his tools. So, those type of people are going to be affected. And I think we're going to get some sort of recognition of that risk in the first quarter. So,
Do you see the government helping out?
well, that's an open question. I don't have a good answer to that, Steve, because my friend who lost his house and his truck and his tools applied to FEMA and has not been helped out as of a couple of weeks ago. So
Yeah,
um,
I have a good friend down there who's got so far gotten $700.
yeah,
I mean,
it's just
it's
not. It's a sad situation because lives were completely disrupted and
yeah,
trying to get back on their feet. They're not finding a lot of help from what I'm hearing.
no.
But the
All
banks
right, thanks for that.
giving some forbearance, and that's the good news.
Okay, thanks for that. We'll keep our eye on those big banks. Robert, what are you looking at today?
I'm looking at Charlie, and I got a question for him.
Uh-oh.
Okay,
Are
hit
you
him.
booking any of your profits in your bank trades yet, or are you still riding them all?
I have taken some off. Put it this way: I'm not really chasing anything here. I think they're a little over their skis. I mentioned yesterday we have a banking conference next week, and I doubt we'll get mid-quarter updates because there's another banking conference in March where we're more likely to get those mid-quarter updates. But if we do get something next week, it's going to be more along the lines expenses in line, credit quality benign, the LA fires aside. And if there are surprises, it's going to be on the revenue side. And the two areas where I think you could get surprises would be on net interest income and on capital markets. And net interest income, I think, could be soft because we've had a decline in nominal rates, which means your reinvestment of if you got a treasury security from 2 or 3 years ago that's being reinvested today, it's being reinvested at a lower rate than what you would have expected, given the rally that we've had in rates over the last 72 hours. And then the other thing is the yield curve is flattened. I mean, the 1 and 3 month yields are slightly above the 2 and 5 year. So you have no yield curve on which to play with. So NII, and then you don't have any loan growth yet. Now that was expected, so that's not new. But I think this flattening of the yield curve and the lower nominal rates has caught people by surprise. And so when guidance is given in mid-January for the first quarter for 25, it's based on the forward curve. And the forward curve, if you go back to mid-January, the forward curve was talking about a Fed funds rate of 4.3%, but a 10-year of 4.8%. And now we've got a 10-year around 440. So I think NII could be a little soft in the first quarter, and that could be disappointing. And then you go to capital markets, and January has been really disappointing on investment banking. I mean, we've had 20 to 30% declines year over year just in the month of January in things like equity capital markets, debt capital markets, M&A, loan syndications. And I posted yesterday, what the consensus estimates were for the first quarter, and we were up 5% on investment banking quarter over quarter and up 15% year over year in terms of current estimates. So capital markets could be disappointing as well. Now we've got 2 more months left in the quarter, so I don't want to, be premature. But yeah, so I've taken some off. Certainly not chasing anything. If Citigroup came back into, a seven handle, I would buy that. I was talking with Bakes yesterday. He thinks, if it breaks 83.11, then you're off to the races. There's nothing above that. M&T Bank is my number one regional bank. If that came back into the 180, 190 area, I would buy that as well. So I think the fundamentals, longer term still look pretty good for the banks, but I think they're a little bit ahead of themselves. In February could be a pullback of some sort. Sorry, I got long-winded. I apologize.
Yeah, trimming a little would have been sufficient.
Oh, did I say that?
Charlie, do you sell premium against your longs? Do you
Yeah, I
sell
mean
call?
that's what I've done with M&T. I've sold calls against my position there,
And how far out do you just go out to the
just to
monthlies?
March. Yeah,
Yeah.
because I think in March, if there are surprises, there's a banking conference in March where you typically do get mid-quarter updates, and if we do get updates in March, then they're not going to be positive, put it that way. It could be, we're reiterating our guidance, but, it could be we're a little soft in capital markets or we're a little soft on NII.
Okay. So I assume the investment banking business slowdown is just about the administration and the uncertainty around who's doing what to whom.
Yeah, it really is. Because when you talk to these bankers, that they say the pipeline is full, they're hiring, like crazy. That's actually one of the risks is, and you heard it from Jeffries last quarter, is, there is going to be a talent war. And people are bidding up to get these investment bankers. And Jeffries' fourth quarter was disappointing, not from the revenue side. The revenues were very robust. It was the margins that got squeezed because they were having to pay they went out and hired a lot of talent and they had to pay up to keep these guys.
Yeah.
So yeah.
All right. So Bob, you want to talk? What's your takeaway on the Skechers numbers?
I've got three names to talk about. Update. A lot of news, not a lot of action on these things. There's not
Okay.
a lot of tradable intel because of where the stocks are. So start with Skechers, which is my biggest position, and it's been a long-term holding. Um, these guys have a way of shooting themselves in the foot once every 4, 5, 6 quarters, and that tends to keep the stock from ever realizing fair value for what it is. It's a double digit, it's a global powerhouse brand, double digit organic revenue grower. So it's really a growth company, and they had been talking about how strong the fourth quarter was. But in the fourth quarter, the dollar soared. And when a company gets 2/3 of its revenues outside the US, the conversion of the currency could be an issue. So they kind of said, we did 65 cents versus a 75-cent estimate. But if you adjust for currency, it was 85 cents. So they beat the hell out of the number, but they reported obviously that you can't ignore the currency exposures when it's positive or negative. So they kind of, missed that. They guided light. The revenue was up 13%, which is still very strong for a large company. $10 billion in sales this year. Should do 11 billion next year. They've been growing $1 billion a year now this will be the fourth year in a row, 6 billion to 10 billion. That's pretty good growth. So stock hit an all-time high yesterday on the buzz about the quarter being stronger than expected at 77, I believe, 78 maybe. And it's down, down 7% today or 10% now, $7, and down as little as 3 and it's down as much as $7. I'm a buyer of the stock on the disappointment, but I need about a 15 to 20% pullback. So I'm looking as a buyer at 61 to 63, 64, not 67 or 68 or 70. So it's just in that, too cheap to sell and too expensive for me. My buy formula, which requires a 20-ish% price decline in the stock to add to. So full speed ahead on the long-term secular trends that the company are using to grow double digits. They are run like a privately held company because there's a super vote by management for the sake of long-term revenue growth. They execute that very well. They do have lumpy earnings quarters because they're investing heavily. And if there's a modest revenue shortfall, even if it's delivered because of currency, they could have an earnings hit. So that's I'm a solid holder, but not yet a buyer.
Was there anything that just jumped off the page that would give you pause?
I mean, inventory is 100 or 2 million. They had a 13 day spread between sales growth and inventory growth, but they explain that by because of the Suez Canal closures, they had to ship a lot of product to Europe a lot earlier for the first quarter. So they said their inventory is in great shape, and they lost sales in Europe last quarter because they didn't have enough inventory. So in that region. So China's was negative 11%, which means they're not executing as well as Crocs, which I believe was up double digits in China last quarter. They haven't reported December yet, but in the September quarter. So some companies are making China work. They could have executed better in China, but again, this is a stock that kind of trades between 13 and 17 times earnings. And in my opinion, with a stock market worth, 20 or 22 or whatever you want to call it, the median stock being 18 times, it deserves that, if not a premium, because it grows faster, a lot faster than Nike or any of the established footwear companies out there. Grows a lot faster than Ralph Lauren, and Ralph Lauren has a 24 PE now after their turnaround. So
Yeah.
I would, it's just these bombs, these earnings bombs that keep people, reluctant to pay 20 PE for what is really a solid double digit grower as far as the eye can see. And they do have margin expansion, which they keep promising. But then they say, well, but if we get an opportunity to invest, we're always going to take it. And they always find those opportunities to invest. They haven't met an influencer or an old athlete they don't like to put on.
No, they don't discriminate clearly based
Is
on
it,
their
is
effort.
it,
I mean, I wish they would hire. I wish they would hire old hedge fund managers as influencers.
Yeah, they'd be a lot cheaper.
I,
who's their guy? Tony Romo? Is that the guy?
they got a lot of those guys. Yeah, like
Yeah,
people like that. Yeah, Howie Long. They just signed up
that's
Howie
right.
Mandel. There's a cute commercial with Andy Reid. I put on the stock
Yeah.
games if you click on it.
Guys
So.
guys that can't bend over and reach their shoes.
Exactly. Well, I bought a pair of slip-ins and I like them so much I bought a few more pairs. They went for volume this quarter. They had like -0.5% to -1.5% pricing in different regions. So they had double-digit growth in the mid-teens in unit growth, and they're trying to get people to try the slip-ins because once you buy one pair, people kind of try to tend to like them enough to buy more pairs. So they're trying to generate unit growth in the market, and they were a little more promotional. I think they said unit prices would be flat year on year, and they were down 1%. That's not a big deal, but it does show you they are promoting a little bit.
So how much of their business is China and Europe? And I'm
Um,
asking that because of the tariff bombs that we get at least
yeah,
weekly.
and
And
well,
how much exposure do they have for that?
they have a way to. There will be costs with the tariffs, but they have an ability to move production around from China to other parts of Asia and ship directly and India and ship into different parts of the world. So 2/3 of their revenue, well, not last quarter and last year, it went closer to 60%, is scheduled to be from the rest of the world. And obviously, the U.S. is the biggest market. China is the second biggest market. At one point, it was around 20%. Now that's fallen off quite a bit since because they've had 2 years where they were flattened down, and the rest of the world is growing. But they have a very large European business, very large Latin business. They have non-Asia. They're in 100 countries, and they're totally spread around the globe, which means they have the initial to solid distribution in all the major global footwear markets, the consumer markets you could be in. They're not just concentrated in India or China or Brazil or the US. So the rest of the world, ex China, grew, I think, in mid teens for them last quarter, and China brought it down to 10% because China was so bad and so large for the rest of the world. So they're doing really well in the US, and they're doing really well in everywhere but China right now. And they do have these currency hits that they said, 20 cents away in the quarter, and we'll take 15 to 20 cents away this year, at least, with most of it starting in the first quarter. So the first quarter outlook took a hit as well from the currency.
Yeah. Yeah, we've been hearing the currency hit from a lot of people, including
Yeah.
Amazon last night.
If you prepare the street, they look through it. If you don't, it's a big shock, and then people sell. And they did a shitty job of telling the street about that risk.
Yeah.
Hey, Robert, you're known for some of your great calls on some of these small caps or micro caps. What name are you looking at these days that intrigues you?
Yeah, I wish I had a buy, but I've had so many big winners in the last 6 months. I've been trimming.
Yeah.
I've been trimming a little bit.
Ah, okay.
I was just
And that's all you're going to say? Just trimming a little bit? I mean, you're not going to go into
I
detail?
don't need to make it long-winded. No, I took some profits in Koru Medical, which had doubled, and TATT, which had doubled. I didn't sell any Ceragon. The one laggard that I have that is the riskiest but sexiest stock I own is a lithium.
Electrovaya.
Yeah, it's called Electrovaya, and they did 24 million in revenues 2 years ago, 45 2 years ago. In 23, 24, they were 45 million after being 22 the year before. So they doubled and then digested their sales. And they think they could do 70 million this year and 110 to 120 million next year. So then they say they could triple the business in 2 years. And if they do that, the stock will not be one-time sales. Now, their key feature to their battery is you can't light it on fire. Okay? They try to light it on fire. They bring a blowtorch and you can't catch a cell on fire. It smolders, it gets hot, but it doesn't actually ignite. And it has a ceramic separator, which is a hard material, between in the cells. And a lot of people use polymer, and the polymers, they actually shrivel and shrink through usage. And that's what causes the fire risk as you cycle through the use. Guys, there was a big fire in California about a month ago from a Vistra battery storage factory for storing, and they burned $150 million of Panasonic batteries. I heard, and
that
it
was
was
nasty.
a controlled fire. Once it goes up, you can't.
No, you can't put it out. You just got to let it burn.
So I told these guys they should take a blowtorch and a battery and go around to the CEOs of all these independent batteries and all the hyperscalers and say, you don't want to use anybody's batteries but ours, and you're outside your data centers for backup storage or primary storage if you're harvesting renewables. So, it's a business that I lived through a year of crappy numbers because it was a big disappointment last year, fundamentally, because the IP is so strong. Their biggest customers, Toyota, they export these from Canada to Sumitomo in Japan, and nobody exports the lithium-ion battery IP from the U.S. to Japan. Japan invented and perfected the technology. China stole all the Japanese IP, and now they compete too. So it's a company that has 3 to 5x potential if they grow the way they say they should grow in the next 2 to 3 years. It's also high risk because they just bought and built out a very expensive factory for them, a $50 million factory in New York, upstate New York, in order to produce the cells and assemble the batteries here. Right now, they pay a contractor in in China to assemble their cells, and then they import the cells to Canada, and they assemble them and send them to the U.S. So there's a risk there that there's a short-term pause in orders because they don't know how to price the product with or without tariffs. So there's a risk that there could be some tariffs, from China as well as from Canada, not from China to Canada, but from China to the U.S. They're going to start assembling batteries in Jamestown this year, and then from Canada to the U.S. So there's this uncertainty that could pause the customer. But they have some of the world's best customers right now. I think Amazon is their biggest customer as we speak. They're not allowed to talk about it, and they sell into the forklift business primarily, and now they're expanding in other areas. But Amazon is doing a test for stationary power for them, and if Amazon data centers would start using their product, it would be a massive new order for them.
Robert,
is it just a hazard? Is their differentiator a hazard, or is it do they get better performance out of the battery, or it's a combination of both?
The battery performs in line with the industry standards. It's not better.
Just doesn't catch fire.
No, it also lasts 3 times the cycle life because the separator doesn't shrivel during charging. And so they pulled a battery out of a Walmart distribution center. I think it was 8 years old, 7 or 8 years old, had been run 24/7 for 8 years. And it charged up to 93%, 92% of capacity.
Wow.
So it's the life cycle benefit too, which lowers the total cost of ownership. So and they charge a 25% premium. So you have to pay up for these 2 features. But if you're getting 3 times the life, it's a layup decision. But some companies and customers don't want to pay 25% more. They just care about the initial capital outlay.
Right.
And they get the battery business is about a 15 to 20%. The commodity lithium-ion battery business is about a 15 to 20% gross margin business in the U.S. For anybody that participates. They get 35% gross margins. More than double their peers. But, you have the debt, you have Canadian management, which I found to be questionable. And I'm being generous.
Yeah, they've got a history of overpromising.
They're building this big factory, and they hope it'll come. And if it does come, it's very similar to a stock I bought last year, which was a satellite company that had the same characteristics. It had an iffy balance sheet, a big growth plan, and they sort of delivered on the growth plan. They sold a division, and the stock, which I paid $3 for last year, is $18 today. So I sold it all at 12 to 18, unfortunately.
So what do you think the upside is here? You obviously, this is a lotto type of pick. You size it accordingly, but what do you think? Where do you think the stock could go if they do execute? Is this
I would think
$10 stock?
$10 stock in 2 years if they execute. Yep.
Okay.
Yep.
All right.
It's the only
Anything else, gentlemen?
It's the only laggard I have in the nano cap space. So as I said,
sounds like a nice problem to have.
I posted a 2 out of 3 in my terrible $2 stocks. Two of them have doubled up 100%, and one of them's flat. So the flat one, I want to go up 100%. I'm not like Meatloaf. I'm not like Meatloaf. I want 3 out of 3.
We're rooting for Electivia. All right, guys. We're at 38 minutes here. Anything else we want to add before we wrap this up?
No. Sounds like we're ready for the weekend.
Yeah.
All right, let's enjoy the weekend. It is it's still raining here in California. Hopefully it dries out this weekend. But thanks for joining us, everybody, on Wall Street Beats. Just as a FYI, this is our last public freebie. Going forward, all these shows are going to be behind the paywall. So if you want to watch us, you got to be a member. So come check us out at wallstreetbeats.com. I'm Steve Lamar. Thank you, Robert Marson. Thank you, Charlie Peabody, and we will see you on Monday. Have a good
weekend, guys.
Thanks, guys.
Thanks, Jen.
Thanks, Jen.
Thanks, Steve.